Today is our very, very last post-growth entrepreneurship class. We will be covering lecture material in this class today, and we will be covering, for the most part, the topic of investment and finance. Of course, when talking about PGE and bootstrapping, I always get the question, what about investors? What about VCs? What role do they play? So really, I think that that is the question that today's lecture will be attempting to answer. So we're going to start with a deep dive into non-extractive finance. At noon, we're going to have a 10-minute break. And then after the break, we're going to continue with the topic of shareholder engagement. So finance and investment. So really, I think the first thing that you need to understand is that investing is a political act. Money, in general, tends to belong to us. We earn salaries and then we take that money from our employment and we put it in the bank. We make deposits. Of course, the banks then take our money and use that to make investments. We have pensions, that we might get from our employers. We might also match those employer contributions. That money, too, belongs to us, but we give it to the pension funds. We also buy insurance policies and, those insurance policies, again, we're putting that money, into these policies so that if we ever have some form of incident or accident or any kind of an occasion where we need to get that money back, of course, we have right to that money. So really what you need to understand is that the majority of the capital that's sort of floating around in the world actually belongs to us. And this also, of course, has a number of interesting implications, but it is personal choice for us in who exactly we choose to give that money to. I'm going to give you two examples of somewhat well-known fund managers just to illustrate the difference. The first fund manager is named George Soros. You might have heard of him. I mean, he's a fund manager who is quite far, actually, on the progressive left. He has a foundation that's called the Open State Foundation that makes philanthropic donations to pretty much every cause that you could think of on the progressive left. So anything related to human rights, poverty, openness and freedom of speech, and transparency, supporting civil society organizations and countries that might have oppressive regimes. He gets involved in a lot of things and he really throws his money around, which of course has led to him being the topic of quite a few conspiracy theories. But nonetheless, he's quite prominent. Now, a counterexample is a hedge fund manager from New York whose name is Robert Mercer. So Robert Mercer is basically one of the largest donors to the Trump campaign. So in the previous election cycle, I believe that he had given $200 million to the Trump campaign. And another not unimportant point is he's also funded initiatives like Breitbart, which of course is a alt-right news outlet. This should make extremely clear that who you actually give your money to, that this makes a quite considerable political difference. The other thing also that we need to understand is that when we are funding these fund managers, they also make political contributions, right? And particularly in the US, all limitations on campaign contributions have been removed, which basically means that at this point, practically unlimited amounts of money can be used for, I can't say it any other way, but buying politicians, buying certain kinds of policy. There's an incredibly powerful lobby. It's also not just in the US. There's also a very powerful lobby here in the EU. And look, what we need to understand is that everything is connected. Finance is also connected with politics. We can pretend that it's not so, but of course, who we choose to give our money to, that really shapes the world that we're living in. But at the end of the day, of course, all of these campaign contributions and all of these lobby groups, they are ultimately getting funded by money that most likely was paid through fees off of our capital. And at the end of the day, as consumers, it is our choice whether or not we want to give these fund managers our money or not. But this brings us really to the point where we need to make an attempt to understand the money flows. So in general, you have, it really all starts and ends with the asset owners. So an asset owner is, these are basically the managers of the largest amounts of capital. So things like pension funds, again, like banks, insurance companies, sovereign wealth funds. So, for example, if the Dutch government is drilling for natural gas in Groningen, that money goes into this sovereign wealth fund. And, other things, the billionaires, right? I mean, high net worth individuals, they might have family offices. There might be multiple multifamily offices that combine the wealth of several families. Endowments. I mean, for example, the University of Amsterdam, they have capital. That capital gets invested. That's an endowment. So, there's a lot of very large amounts of money that are essentially looking for returns on that capital. So the asset owners then give that capital to asset managers. Now, in these transactions, the asset owners tend to be called limited partners, LPs. And the whole purpose here is that the asset managers are then going to attempt to maximize returns for the shareholders, who in this case are the asset owners. And of course, the asset managers will be charging a fee, most of the time the 2 and 20 we've discussed earlier, for the privilege, of course, of managing this money for the asset owners. So examples of asset managers are things like hedge fund managers, VCs, of course, venture capitalists, wealth managers, hedge fund managers. There's quite a few different kinds. And ultimately, those asset managers, they give the money to companies. So, for example, with a VC fund, it's quite clear, I think, how that money is being redistributed. Of course, it's giving this capital now to these startups or scale-ups, with the hopes that there will be a liquidation event so that these asset owners can retrieve their money. But also with things like, investing in publicly listed companies. In other words, buying stocks. One thing that's kind of interesting to realize is that, of course, a lot of the history of the stock market and also the history of capitalism started here in Amsterdam. So, if you go to downtown Amsterdam, to the city center, and you go and visit Beursplein, and you take a look basically at the Beursgebouw and where the Euronext is located. There's a very interesting painting inside that shows the history and the development of the stock market. In Amsterdam, we had one of the very first stock markets, and the whole purpose at that time was helping to fund the naval expeditions of the Dutch East India Company, the VOC. And of course, since this time, things have changed. I mean, the stock market is no longer only being used for providing money for companies, but it also is being used for, speculation. But nonetheless, I mean, that really was the, sort of the beginning of the stock market as such. And it is really interesting to recognize the role that the Netherlands played in the early development of capitalism. So, all right. So the companies now have this money, and they, of course, are going to give it to us, we the people, because we are being employed by these companies, and also we might be getting pensions, perhaps, from our employers, and in those particular cases, then. Now that money is ours, and we are going to then seek to maximize our own returns. And we do this, of course, by putting that money in the bank, hoping to accumulate interest on our deposits, and also putting that back into our pension funds, where we also hope that cash is going to multiply so we can someday retire. So as you can see, really with these cash flows, it's a circle, and it's going round and round. And ultimately, but the entire amount of cash that is flowing and that is circulating through this system is our money. And I think this is a very important realization to make. Because, of course, what this money is being used for, if it is indeed our money, then we need to start asking questions like, should we perhaps have a say in what this money is being used for? So, but of course, there are huge amounts of extraction in the finance industry, right? I mean, if you go to the Buyouts, basically our Amsterdam financial district, and you look around, there's a whole lot of tall buildings, and of course the money to pay for these tall buildings is clearly coming from somewhere. Also, if you watch Hollywood films, whether we're talking about Wolf of Wall Street or The Big Short, there's plenty of films that dramatize and recreate some of the extravagant behavior of fund managers in different periods, such as leading up to the 2007 and 2008 housing bubble. But of course, up until recently, before the Fed increased the interest rates, it was also quite a fat period, also for the fund managers. So, and truth be told, those Wolf of Wall Street antics, with all the extravagant parties and the strip clubs and whatever else that they're doing, if you ask the question, okay, but where is the money coming from that's paying for all this? Once again, it is coming out of our money as fees. Because when we give these investment companies our money, again, most of the time we're paying this 2 and 20 fee, basically for them to be able to manage our money and hopefully get us returns. So those fees are really one of the largest ways that money is extracted out of the financial system. There's also dividends. So, for example, if a company has excess cash, so-called excess cash that it doesn't need, it can make the choice to give some of that cash back to the shareholders. And if you consider that the definition of fiduciary duty is essentially to provide returns for the shareholders, then essentially, they're in that sense being legally compliant by returning this cash to the shareholders. But of course, this is also a way of extracting financial value out of a company. So also, companies might the finance industry itself might get more money by investing it. So they too may also buy various asset classes. They might purchase stocks or bonds or real estate or Bitcoin or anything else, really, thinking that they can get returns on those assets when they sell them later. So all of this is really different techniques. And of course, ultimately, if that succeeds, then they can get fees also off of that. So these are the main ways that cash are extracted from the finance industry. Now, there's a number of tools that facilitate this whole process and make the extraction happen a little bit faster. So one particular tool is called the stock buyback. You've probably heard the name, and you've heard that stock buybacks are not all that great for society. I'll explain in the next slide why this is the case. Also, merger and acquisition activity, those kinds of moments tend to lead to large fees, and also large bonuses and compensation packages for management and things like that. Sometimes we wonder why all these companies are acquiring all these other companies, and we can't really seem to make too much sense out of it. Like, why is one slightly larger company so much better than a couple smaller companies? But of course, most of the time, the management is financially incentivized to do this. Considering stock buybacks, of course, the first question then is, all right, but what is a stock buyback? What a stock buyback really is if you consider the total valuation of a company. So basically, a company has a particular estimated value, and then there's a certain number of outstanding shares that are issued on the market. Then, of course, you're going to have a particular price per share, for each of these shares of stock. Now, if a company has so-called excess cash and it uses this cash to buy shares of stock back from its shareholders, then what happens is the price per share goes up. And the reason why it goes up is because essentially the valuation of the company remains the same, but there's fewer shares of stock in circulation. So this is simple mathematics, of course. Dividing a number by a smaller number, leads to a larger answer. So in that sense, it's quite logical. So by buying back a company's own stock, it's basically artificially increasing the price per share of that stock. Now, there are these hedge fund managers that are called activists. And when we call them activists, of course, we're not talking about Greenpeace here. What we're talking about is hedge fund managers that take a very small stake in a company with the idea of encouraging that company to increase the amount of dividends, to perform more stock buybacks, so they can essentially boost the price of the shares, and then typically they sell the shares and run. Now, activist hedge fund managers have been active since the 1980s, so this is not not a new concept, and there are plenty of more famous activist hedge fund managers, people like Bill Ackman or Carl Icahn, a number of somewhat famous names in the finance industry. All right, so the activist comes in and they buy a relatively small share of a percentage of the company. Then the question, of course, then becomes, but how do they leverage such a small percent of the company to make such large sweeping changes? Well, the reason why most of the time this succeeds is because the CEO is financially incentivized to go along with these activities of the activist hedge fund manager. The reason why is quite simple. It's because the CEO oftentimes receives equity compensation, right? So, of course, CEOs also get salaries in cash, but the majority of their compensation by far is in shares of stock, which means that if that same CEO makes the decision to buy back shares of its own stock, then it means, again, the value of each share goes up, thus meaning that the CEO is maximizing the value of his own equity compensation. Pure self-interest. So, basically what winds up happening is that all of the free cash of the company, in some cases, winds up getting used for these stock buybacks. And it's sort of hard to claim that cash could not have been used for some productive business purpose. Of course, you need cash in a company to reinvest. You need it to be able to pay your staff fairly. You need it to make better products and services. You need cash to bring down the prices for customers, or to provide quality assurance, or to invest in research and development for your next generation of products. But of course, that cash that you dividend out of the company or that you use for share buybacks, this is cash that you then don't have to actually make the company better. But it actually gets worse than this. What sometimes happens is the CEO and the activist hedge fund manager together will actually start disassembling the company for its parts to generate more cash that it can then use to perform more buybacks. So they'll do things like lay off huge groups of people, sell divisions of the company, take on huge amounts of debt onto the books of the company, all for the purposes of generating more cash that can be used for more buybacks. And after this happens, then basically the hedge fund manager, they drop those shares, like a hot potato, and they run. Same thing with the CEO, actually, because most CEOs, I don't think their tenure is longer than like 4 or 5 years. The CEO also leaves, and then they get replaced by a new CEO. And at that point, all of this is no longer the CEO's problem. Now the problem that the fact that it's been completely drained of cash, this is the problem of the company itself. And it's the problem of the employees that are still working there. And it is the problem, of course, of society, who then has to deal with this hampered company that's much less able to function than it was before. Now, entire industries have been plagued by this kind of stock buyback activity. This actually cost the United States its dominance in semiconductors because, these semiconductor companies, the leadership was too busy doing stock buybacks and essentially weakening the company itself, to enrich a very small number of the privileged few. But, this has happened, of course, throughout multiple industries. And we need to understand this is value destruction. It's not value creation. Now, the other asset managers and limited partners that happen to be involved that have purchased these same shares of the stock, they will likely support this activity too, because when the buybacks occur, of course, then, for those that don't sell, for those that are holding their stock, then, of course, their price per share goes up as well. So really all the financial interests are aligned in this case to make sure that these buybacks happen. But of course, none of this is in the best interest of the company or of society that might be relying on this company to actually perform something that society needs. One case study of a particularly egregious offender is Apple. So I would like to, by the way, thank Luke Barrett, who did his thesis research at the University of Surrey. He's from Tim Jackson's group, and he put some of this material together, which these slides are based on. So if you consider the largest offenders of stock buybacks in the last few years, the number one top company producing that's performing stock buybacks is Apple. So for years, Warren Buffett, who of course is famous as being the most successful investor on the planet, he was pestering Steve Jobs back when Steve Jobs was alive to perform buybacks of Apple stock. Steve Jobs would have none of it because he was like, no way, man. We need that cash to build products that are insanely great. That was Steve Jobs. But sadly, of course, at a certain point, Steve Jobs died and he was replaced by Tim Cook. So Warren Buffett, of course, at that point went back to Tim Cook and said, hey, Apple has about $100 billion lying around in cash. Don't you think some of that cash maybe should be returned to shareholders? Of course, Tim Cook has equity compensation as a large part of his pay package. So then he thought about it and was like, you know what? I think that's a really great idea. And thus began an incredibly huge spate of stock buybacks that led to literally Apple performing more buybacks than any other company in the market. Warren Buffett was not the only hedge fund manager that was encouraging this buyback activity. Carl Icahn, who I mentioned previously, he also wrote a letter to Tim Cook encouraging this. David Einhorn, another hedge fund manager, he even filed a lawsuit against Apple, saying that you have too much cash lying around. You need to, your fiduciary duty dictates that you give it back to your shareholders. They were rewarded handsomely for this activity. After 2 years, Carl Icahn sold his Apple stock for $2 billion in profit. That's not a bad return on investment, for such an activist campaign, right? Warren Buffett also, up until now, I mean, his return on investment from Apple has been roughly 100 billion US dollars. And also David Einhorn, who filed that lawsuit, also made over 1 billion US dollars worth of profits. That is a good incentive to file more lawsuits, right? So Apple is not the only company that has been performing buybacks like this. Another salient case study is Meta. So in 2020, a pension fund in Michigan had filed a lawsuit against Meta due to some suspicious timing of stock buybacks that were performed by Mark Zuckerberg. So Mark Zuckerberg had wanted to sell roughly 75 million US dollars worth of his shares in Meta because he, at that time, just so happened to be setting up his personal philanthropic foundation, the Chan Zuckerberg Institution. According to the lawsuit, the buybacks were performed and timed just in the period before Mark Zuckerberg personally wanted to sell his shares. On top of that, it wasn't only Mark Zuckerberg, but also Sheryl Sandberg and also Peter Thiel had also sold their shares of stock at roughly the same moment. Now, the question here is, why is this not considered insider trading? Because, of course, Mark Zuckerberg knows when he's going to be doing these stock buybacks. He knows how many he's going to do, and he knows when he's going to be done with it. He doesn't have to time the market because he's creating the situation himself. So, so really, I mean, we need to ask ourselves why, is this not, and also the involvement of investors, to promote these buyback activities when they themselves hold a financial interest in it happening. Why is this not considered market manipulation? These questions aren't being asked, but they should. Now, not all activist hedge fund managers per se are doing things that are bad. I mean, not every fund manager is extractive, and some activists actually are more on the social and environmental responsibility side of things. So as a contrasting alternative, I want to tell you the story of engine number one. So engine number one, I mean, to me, this is sort of one of the most hopeful things that happened, I believe, in 2021. They're a tiny hedge fund manager from California. And what they did is they took a minority stake of 250 million US dollars, roughly, in ExxonMobil. Now, 250 million in ExxonMobil is nothing, really, because ExxonMobil is an incredibly huge company. And of course, such a small stake barely moves the needle. That being said, though, engine number one spoke with ExxonMobil and they told them the following. They said, gas and oil are out. The regulatory environment is getting more and more hostile. The resources are getting used up. And let's face it, you haven't been performing financially all that well recently. So we think that you would be far better served by taking that cash, pulling it out of gas and oil exploration, and instead putting it in renewables. Needless to say, ExxonMobil was not thrilled with the suggestion. However, engine number one formed a coalition. So they partnered with a number of the large asset owners in California, such as the California State Pension Funds and the Teachers Pension Fund, CalPERS and CalSTRS. They also partnered with the big three investment firms, BlackRock, Vanguard, and State Street. And finally, they also partnered with ISS, Institutional Shareholder Services, which is a proxy advisory service that also advises other pension funds how to vote. More on that later. So having formed this coalition, engine number one managed to get enough shareholder support for its resolutions that it managed to replace the three members of the ExxonMobil board of directors with renewable energy experts. So if you stop and think about this, a small hedge fund managed to accomplish more than what generations of Greenpeace activists have done. That's pretty amazing. And it really shows the power of understanding how to leverage the financial system, how to leverage corporate governance, right? So what engine number one did next was brilliant. So what they did is they started something called an ETF, an electronic traded fund, that tracked the stock market. So in other words, it was a S&P 500 index tracker, where S&P stands for Standard & Poor. It's basically an index tracker tracking the 500 largest companies on the U.S. Stock market. So in other words, when you buy this index fund, you're quote unquote buying the market. Now, this is exactly the same product as you would get from many other major players. Of course, BlackRock and Vanguard, they also put out S&P 500 index trackers. But what engine number one did is essentially by releasing this index fund, it was like a fair trade product. So in other words, if you purchase this ETF, this index tracker from engine number one, then you know that the underlying proxy votes of that capital go to support engine number one's activist campaigns, right? Whereas if you just purchase that exact same product for more or less exactly the same price from BlackRock or Vanguard, then you know that they are not going to be using those votes in that way. So what they essentially did is they gave their shareholder activism a business model. And that's brilliant because the majority of the organizations that do shareholder engagement tend to be NGOs, and they tend to be reliant upon donations and subsidies. You know, we've spoken earlier in the class about how unreliable those funding sources are. So by giving this shareholder engagement a business model, engine number one really did something that is potentially transformative. Now, engine number one probably will not be the first nor the last financial company to do this. And also, at the end of the day, engine number one is also a commercial company, right? Make no mistake. And, good ideas also can be made even better. I mean, imagine if this form of an ETF were created as a non-extractive company with things like nonprofit entity forms, golden shares to prevent the whole thing from being sold, compensation caps, reformed fee structures. I mean, there's ways that you can make a fund like this less extractive to really ensure that there is no perverse incentivization also for the fund managers to perhaps make the wrong decisions at a certain point. Of course, since the campaign against ExxonMobil, engine number one has taken some heat for actually voting against some climate resolutions of banks that were related to Scope 3 emissions. And people were starting to wonder, is engine number one selling out? Are they turning into just like yet another normal hedge fund? And look, I mean, what I can say in their defense is that engine number one has to walk a very fine line because, of course, in building coalitions with large asset owners and also with the big three and ISS, they do need to have some level of political correctness and acceptability to build these coalitions in the first place. And thus, their strength, of course, being in building these networks, that they can't act too much like activists. They still have to make it clear they're putting fiduciary duty first. And of course, this for them is a very difficult balance to find. There's other players, such as the NGOs, that don't have to walk that balance quite so much. But I will say that as being an asset manager, it is also difficult for them to really be able to mix doing the right thing with also finding the right explanations that support fiduciary duty, that explain why they're doing it. So, this led to a lot of developments, and really it sent shockwaves throughout the entire finance industry. It wasn't just the progressive left who was inspired by this action, but also the conservative right. They too realized that corporate governance can be leveraged for changing the world in a way that you ideologically see fit. And the conservative right also started mobilizing. What they did is they started making a lot of noises about what they call woke capitalism, right? And by woke, what they mean is any form of investment that involves ESG, where ESG stands for environmental, social, or governance issues. Anything that includes things like diversity, equity, and inclusion is labeled woke. And anything that you would call stakeholder capitalism. In other words, trying to put the interests of other people besides the shareholders ahead. So the criticism coming from the conservative right towards woke capitalism is that the so-called corporate elites on the progressive left, that they're actually putting their own ideological views, and they're basically putting activism in support of those views above fiduciary duty. Now, Republican politicians in the U.S. then mobilized around this idea. 17 attorney generals in so-called red states in the United States have, first they signed a letter decrying ESG investing. And the second thing they did was proposing bills to literally punish Wall Street firms for doing any form of investing that has anything whatsoever to do with ESG. The Republican governors also have gone a step further in some of the states, and Texas, Florida, and West Virginia also have been, compelling the pension funds to divest the money that's already invested in asset managers that support ESG. For example, Ron DeSantis, he recently has attempted to divest $13 billion in Florida public pension fund money from BlackRock. And you would ask the question, well, why BlackRock? Simple. BlackRock was involved with that campaign against ExxonMobil with engine number one. So basically, these Republican politicians are trying to punish the large asset managers for being involved in these kinds of ESG-related campaigns. So the divestment attempt, I believe, didn't succeed, but they're going to continue trying. So whether or not they actually can divest, or it's just they're making a lot of noise, it has been effective. And we have seen some effects since this whole finance war broke out. In December of 2022, Vanguard pulled out of a net zero alliance, much to the disappointment of a lot of people on the side of climate justice. And let's be clear, this is costing taxpayers money. When Texas divested from the fund managers that were involved with ESG, just the act of moving this money around from one fund manager to another, it's expensive, right? And the taxpayers foot the bill. And in Texas, the taxpayers wound up paying between $300 to $530 million in 6 months. So, of course, the conservative right has been having the criticism that these, left-wing corporate elites are putting activism above fiduciary duty. But then, the progressive left is accusing the conservative right of exactly the same thing, basically of putting their form of activism above fiduciary duty. So another development is that what I would call alt-right fund managers have been popping up. And a famous example of this is Strive Asset Management by Vivek Ramaswamy. And you can see here that he wrote this book, Woke Incorporated. And you can see already from the subtitle, Inside Corporate America's Social Justice Scam, you can already see what tone this book is taking. Now, look, just for shits and giggles, I read the book. And what I actually found was that if you ignore some of the right-wing ideology and the Republican political diatribes, the book is actually quite similar to the book Winners Take All by Ananda Giridharadas, who very much is a part of the progressive left. Both books very strongly have the message that there is too much greenwashing in ESG and social enterprise. which is true. So again, if you remove the ideology and the political beliefs, actually both books are getting at the heart of exactly the same thing, which of course is a kernel of truth that can get people to follow the movement on either side. So, but for the rest, if we were to divest all of this money away from the BlackRocks of the world and instead to give it to these alt-right fund managers like Strive, what they can do with this capital at this point is they can use this to perform engine number one style board takeovers at companies that they themselves consider to be woke. So in other words, what they could do, for example, is attempt a board takeover of a woke poster child like Disney. Disney has long aroused the ire of the conservative right because of its very strong progressive left views. Disney is very much in support of things like diversity, equity, and inclusion. Of course, they spoke out very vocally against Ron DeSantis's "Don't Say Gay" bill in Florida. And, they also, of course, through their cartoons, through the films that they make, there's a certain content that promotes tolerance and diversity and acceptance. And, these films also, of course, do have a certain agenda and have a certain view of the world, right? Of those people who are making these films and also of the corporate leadership. But this, of course, makes Disney a very attractive target. So let's say, hypothetically speaking, that one of these conservative right fund managers is able to do a board takeover on Disney. See, what could happen next is, in theory, these new board members could decide to replace the CEO of Disney. And if this happens and the CEO is replaced with someone on the conservative right, then what this means is that now the entire corporate resources of Disney is now made available for use for someone with a completely different ideological and political agenda. So basically now the entire Hollywood filmmaking machine of Disney could be used to put out films that are ideologically different. That rather than celebrating acceptance and diversity, maybe they could instead be celebrating how great whites are, or, or how actually immigrants are hurting everything, or whatever. But the point is that, you can start using that company to perform things with a slightly different agenda. The other thing also is that in the United States, of course, you can make unlimited political campaign contributions. So you can then take a bunch of that excess cash of Disney and then use that to reward the Republican politician that divested that pension fund money in the first place. Thus ensuring that politician continues these kinds of actions, thus supporting more of these board takeovers, rinse and repeat. You've basically got a cycle at this point. And if you ask me, the prospect of this is terrifying. If I say that there is a war that is brewing in finance right now in the United States, I'm not exaggerating. This is a war, but most people at this time don't know, and they also don't see it. Now, it's very easy for those of us in Europe to think, yeah, but that's just the United States, right? Of course, the US is kind of screwed up. It's always having weird political issues. None of this really applies to us here in Europe or in other places. But the problem is that's not entirely true because capital is global. So in other words, Texas pension fund money can just as easily be used for doing a corporate takeover of a Dutch company or a European company or a company really in any other part of the world if they feel like doing this. So really this so-called American problem, this is actually all of our problems, right? So, and by the way, I use Disney as an example, but this actually is not even hypothetical because Disney right now is in the middle of such a proxy battle. The activist investor Nelson Peltz from Trian Asset Management, who also happens to be a prominent Republican donor, he is right now in the process of trying to get a board seat at Disney. So we need to pay attention to this because these are developments that are happening right now. And if they are successful, they can have a very large impact in shaping the world that we're living in. Another example of this, of course, that's quite prominent and that's been in the news quite a lot recently, is another example of a very clearly politically motivated takeover of a company from the conservative right, Elon Musk's LBO on Twitter. So when I say an LBO, LBO stands for a leveraged buyout. And basically what that means is it is buying a company, so a corporate acquisition, but in such a way that it's mostly debt financed, and a large portion of that debt that is used to finance the purchase is actually absorbed by the company itself that's getting purchased. In other words, the majority of the money that was used to buy Twitter actually turned into debt for the company Twitter itself. So the technique of the leveraged buyout, the LBO, I mean, this has been happening for a long time, particularly in the 1980s. A lot of LBOs were happening. At that time, they weren't politically motivated. They were rather just being used for maximizing shareholder value in extractive ways. So, but of course, nowadays with Elon Musk, I mean, it was incredibly clear that he was not happy with Twitter's progressive left agenda, and he wanted to bring political change to the company. And he has succeeded wildly. I mean, he got rid of 80% of the staff of the company. He fired the content moderation and the ethics teams and many other teams. He replatformed Trump and other leaders from the white nationalist movement. He released the most damning content that he could find from the previous leadership to journalists in his so-called Twitter files. He is doing everything in his power to rebuild Twitter as a conservative right media platform. So, of course, the real question now is he going to be able to get out of this unscathed? Is he actually going to be able to sell the company again in such a way that he's not going to lose a very large amount of money? And that, of course, yet is unclear. Of course, I don't have a crystal ball. No one does. So at this given moment that this is being recorded, none of us know which way it's going to go. But at the same time, though, what we do know is that he is in the process right now of basically disassembling the company for its parts. I mean, he has disassembled the company. You can't get rid of 80% of the staff and have a company that's as well functioning, of course, as it was before. And he, of course, the illusion that they can create then, because of course people are always the most expensive assets on paper, assuming that the advertisers don't leave and Twitter can continue to bring in the same amount of revenue, then on paper he can basically say, look, our costs have gone down, by 80% because all the people are gone. And, and our revenue has stayed the same. Thus, look at how much more profitable Twitter now is. I mean, of course, this right now is exactly what he's trying to pull off. We'll see if it works. But if it does, I mean, you can rest assured that these kinds of politically motivated corporate takeovers will start happening considerably more often. But also, what this really does also illustrate is how much power someone has if they understand how capital works, and if they understand how corporate governance works, and if they have short lines to investors and limited partners so they can basically put together these kinds of deals and be able to secure the funding for it. And I believe someone from Tesla had actually called, Elon Musk, I think the Michael Jordan of fundraising. I mean, that is definitely one of his superpowers in being able to line up capital. And he's done so time after time for all of his companies. So, but the point is, with this kind of leveraged buyout activity, this is an example of the conservative right doing it, but the progressive left could also just as easily perform these kinds of corporate takeovers using the LBO as a tool. So that leads to the question, really, what else can you do with an LBO? One particular thing that you might be able to do is what I would call an exit to steward ownership. So in other words, let's say that you have a founder and CEO who owns the shares of a particular company. The company itself could assume a debt position, basically buying off the shares of stock from this CEO and co-founder, and then they can give those shares to a foundation. Then, of course, because the company is assuming a debt position, then they can, pay off that debt to the founder who handed over those shares over a certain number of years. And of course, this is a very interesting way to transform a privately held company into a steward-owned company. So, I mean, this can be useful. It's also very similar in nature to Zebras Unite and their concept also of exit to community, which is essentially doing the same thing to basically transform a privately held company into a co-op. But I mean, another potential example of how one could do a leveraged buyout on a company in an attempt to transform things could be, I mean, imagine if you used a leveraged buyout to purchase a pharmaceutical company. I mean, something like Merck or Pfizer or Moderna or whoever. I mean, Sanofi. and imagine then if you took their entire patent portfolio and then basically dumped it into the public domain. Stop and think how many lives you could save by doing this. I mean, one motivated individual, I mean, I doubt Bill Gates is watching this video, but if he were, I mean, of course, he also could use his untold billions, in the same way that Elon Musk is doing it, and could just as easily perform this kind of a takeover of a pharmaceutical company. And look, it doesn't even necessarily have to mean the end of the company either, because at that point, the company can basically pivot into making generics, And at that point, probably out of reciprocity and gratitude, a large portion of the market in the world would continue buying drugs from this company that had just released its patent portfolio into the world. I mean, if you want to talk about moving the needle in a very, very tangible way, I mean, do something like that, right? And it just takes one person who understands how corporate governance works and who has the networks and the understanding of finance that they can build those networks and then leverage this. It's powerful, and this can be done whatever side of the political and ideological spectrum you're on. Left, right, doesn't matter. I mean, the conclusion I'm trying to make here is that finance is a very powerful tool. So this brings us to the concept of ESG investing. I've mentioned it several times, but I would like to go into a little bit more detail into exactly what ESG is and what it means. So ESG stands for environmental, social, and governance. And historically speaking, ESG most of the time has meant the divestment from what one would call sin stocks. So in other words, companies that make weapons or tobacco or alcohol. Of course, these days, gas and oil has become somewhat of a sin stock. But, and divestment can work. For example, divestment campaigns against apartheid, South Africa, helped to lead to the downfall of apartheid. So leveraging finance like this can be a powerful political tool. However, there's a thing, though, with divestment, and it's that every time you sell stock, it implies that there is somebody on the other side of the transaction. So in order to sell something, it means somebody else needs to buy it from you. Without a buyer, you can't sell. But if you are ideologically divesting from gas and oil, then, for example, then what this means is that whoever purchases that stock from you probably does not share your views about gas and oil, and they might have super different opinions. And here's the thing. Whoever actually owns that share of stock gets to vote in the annual general meeting, and this determines the policy of the company itself. So by divesting, basically what you're doing is it's like stating, okay, but I'm going to change the world by not voting in the next election. I mean, clearly in politics, that doesn't work. And in corporate governance, it also doesn't work. I mean, the whole principle really with divestment is that you're so-called, increasing the price of capital for the company. But in practice, I don't think this actually changes things enough to have a really effective effect on the companies. But what does happen, of course, is, again, you're giving away that proxy vote to somebody who doesn't share your ethics and your morals, and that doesn't necessarily make things better. But, but there's a huge controversy right now in this woke finance war about ESG, about whether or not ESG comes into conflict with fiduciary duty. In other words, are we putting our political and ideological views and climate worries ahead of fiduciary duty, where, of course, fiduciary duty is defined as returns for shareholders? So those who are in support of ESG explain it as such. What they're doing is they are pricing in systemic risks. In other words, if the climate goes to hell and the world turns into a big fireball, that's probably going to be really bad for their investment portfolio. And thus, including ESG concerns is in line with fiduciary duty. Of course, the other side does not believe in any of this, so they don't accept this as an argument. But this is basically the arguments that we're seeing at the moment on both sides. But one thing that has been certain is that ESG has seen attractive returns over the last number of years. In other words, ESG investment products and portfolios have financially performed better than ones that are not ESG or oriented around things like social enterprise. If you think about it, it's kind of logical, and it's because I would say on average, when you're dealing with social enterprises and any company that really considers themselves as working towards things like social justice or climate justice, they're probably going to be slightly less extractive as companies. And on top of that, they also are less likely, I would say, to have scandals. Because they're probably most of the time, and look, there's always exceptions, of course, there's greenwashing, but on average, though, these factors have led ESG portfolios to perform somewhat better. And this, of course, has led to the very large rise of ESG. ESG has gotten popular for all the wrong reasons, and this is the reason why, all of these ESG portfolios and, your green pension fund and green this and green that. I mean, the reason why this has all popped up is quite simply because there's money in it. Most of the people that are involved with this on the financial side and, the industry as a whole, it's not out of pure self-interest, but it's rather about because in this particular case, the self-interest just so happens to be aligned with doing the right thing. Nonetheless, seize the moment, right? So, this is the reason why ESG has become so large in the last number of years. So we left off talking about ESG. Of course, ESG, whether or not it is providing decent returns, there is another side of it. And of course, that problematic side with ESG is that there genuinely, authentically is too much greenwashing. Of course, we do have people like Elon Musk that are shouting ESG is bullshit. The sad part is that to a certain extent, they're right. And the reason, quite simply why, is because there is too much financial extraction in ESG. The problem is when the progressive left builds too much financial extraction into ESG, the real problem is that we are wasting our credibility, in claiming to be creating companies and financial vehicles that are doing the right thing. Of course, as long as financial value is also leaking out of these same vehicles, then of course there is a very clear conflict of interest, and this makes the whole argumentation not very credible. And this, of course, is what the conservative right is playing on right now in the finance war. If it wasn't for all of the greenwashing, then of course they would have no plausible arguments against ESG. But of course, because ESG is very heavily greenwashed, this is something I believe that the progressive left needs to address, because if the progressive left does not, quite simply, the conservative right will win. So what exactly then is the problem, and how is this greenwashing taking place? First of all, it's not incredibly clear what exactly impact means, and oftentimes things that are defined as being impact driven are quite simply laughable. Of course it's subjective, but things like the EU taxonomy and the way that they said that gas and nuclear energy are in the EU's list of sustainable investments. Things like that really do just scream corporate conflict of interest, in getting this kind of stuff into. But of course, with the politicians, of course, it's not easy. Yes, you have the lobby groups. Yes, you have geopolitics and the current situation that's happening right now in the Ukraine. Of course, it's not black and white. It's not cut and dry. There's a lot of different concerns that need to be weighed here. But of course, as long as gas and nuclear energy are on this list, it's not going to be very believable to a very large class of people. The same thing also with impact metrics is that, of course, these metrics are being issued in order to measure things like carbon emissions. And of course, what you can measure, you can then influence, right? But the only problem, though, is that what these impact metrics oftentimes are measuring is not so much the impact of the company on the environment, but it's actually measuring the impact of the environment on the company. Which, of course, for those who are thinking logically about social and environmental impact, of course, this manner of measuring is backwards. But it sort of has to be this way because of fiduciary duty. There is no law saying that companies need to do the right thing, but there is a law stating that the companies need to maximize returns for shareholders, which basically means that in trying to work towards things like social justice or climate justice, it needs to be couched in this language of shareholder returns in order to have a legal backing for it. But this also makes the impact metrics considerably less believable. The other thing also is that a lot of the companies that are running and creating these metrics, they are commercial companies also, thus leading to a financial conflict of interest also with those who are producing the metrics. Plus, the metrics tend to disagree with one another. They'll come into conflict. You've got many different companies that are producing these kinds of impact metrics. MCSI certainly is one of the large ones, but the Domini 400, S&P puts out their own metrics. We have Sustainalytics here in Amsterdam. There's a lot of different providers of these kinds of impact metrics. The other thing also with impact metrics is it does tend to be somewhat myopically focused on the E in the ESG, in other words, environment. So there's a lot of carbon carbon emission measurements, and basically the thing is with the E, it's sort of out of the E, the S, and the G. It's kind of the easiest thing to deal with, right? Because carbon emissions, that's sort of clear, that's cut and dry, right? And this makes the E very popular, right? The S is also still sort of popular, but it's a little less tangible because we know that poverty is bad and we know that it needs to be stopped, but how exactly are we supposed to measure this? So it's still popular, but it's kind of not quite as popular as the E. And then you've got the G, the governance, and the G is more or less completely ignored. And the problem here is that it's the G is ignored because it's actually the hardest thing to greenwash with. I know that sounds a bit cynical, but with the E and the S, there's a considerable amount of extractive, capitalistic, cash extraction that one can do while still ticking the check boxes on the E and the S. But it's really hard to do that while at the same time also reforming the governance structures to be less extractive. It's hard to have it both ways with the G. So But what winds up happening then is actually the E and the S, those are kind of the symptoms, and the G is the root cause. So, so what happens is that we're spending a lot of time and attention on fixing those symptoms, and we're not spending any time almost at all on fixing the root cause. But that's ironic, of course, because if we can fix the G, the governance, then we will get the E and the S for free. So really moving forward and trying to reform ESG and to eliminate the greenwashing and the conflict of interest with ESG, it means we need to focus on governance. We need to take a closer look at topics like executive and board compensation, fee structures, proxy voting, right? I mean, of course, all this G, this governance stuff, I mean, most people think, oh, but this is boring. This stuff isn't that interesting. But look, we're talking about incentives here, and then we need to realign them. Because as Charlie Munger says, show me the incentive, and I will show you the outcome. It's also pure systems thinking. If you want to eliminate the greenwashing in sustainable finance, then what you really need to do is you need to realign those incentive structures. So you need to create non-extractive investment funds. And I'm not talking about resource extraction like gas and oil, but I'm talking about financial extraction. Yeah. So how does one do this? Well, I mean, you can do this by applying post-growth entrepreneurship to the finance sector. In other words, you can start your financial companies in your investment funds in ways that include nonprofit entity forms, steward ownership, and reforming the fee structures. That's it. It's actually pretty simple. And the whole concept of nonprofit finance, is actually not that crazy. It actually has quite a storied legacy. John Bogle, who was the founder and CEO of Vanguard, he used to talk an awful lot about the tyranny of the fees and the conflict of interest between the fund managers and the investors. And by investors, he meant people like you and me, right? So this was part of the reason why he invented the index fund, which he was essentially trying to take fees and drive them down basically to zero. And it succeeded. I mean, there are index funds that are out there nowadays that actually are literally at 0% fees. I mean, they're probably using it as a loss leader for their other financial products, but it exists. But when the index fund first came out, of course, it was called Bogle's Folly. But yeah, folly. I mean, index funds and, of course, passive investment that arose as a superset of the index fund is now 35% of global investment total worldwide. So, obviously John Bogle had his last laugh. And of course, his company, Vanguard, is now one of the top 3 largest asset managers in the world. So, this whole concept of, creating this mutualized mutual fund, in driving fees down to zero, this nonprofit finance that he was after. Look, I mean, he wasn't a saint. I mean, there was a mixture here of self-interest and selflessness. And of course, nothing is black and white. And of course, Vanguard has gotten a lot of mission drift since he left the company. And, it's not perfect, right? But nonetheless, I mean, it really does show that this kind of radical line of thinking can lead not just to successful companies, but one of the 3 most successful financial services companies in the entire world. So there are other examples also of reforming fee structures. Earlier in this class, I briefly mentioned Snowball Impact Management. But they are a VC fund of funds that is run by the CEO, Daniela Barone Suarez. And Snowball basically reformed their fee structure. So it's no longer the extractive 2 and 20 structure, but they've basically changed it to make it the cost of doing business, assuming middle-class salaries and a pension. I believe that they're also foundation owned. I don't know if they have a golden share making it formally steward owned, but in either case, they've also put their mission into their statutes. They have a lot of openness and transparency in their metrics, in their performance. I mean, they're really making a best attempt at creating a non-extractive investment fund, sort of in a very similar fashion also to the way that much of the steward ownership community is also doing this, and also how I'm doing this with a non-extractive cybersecurity company. So anyway, but the point here is that they are showing that you can realign the incentive structures and still be able to run a successful fund. And by eliminating the financial extraction, then you're sort of getting rid of all the conflicts of interest and distractions, meaning the fund can actually really focus on what it needs to focus on. And in other words, I mean, that basically is helping, impact companies to grow and get bigger. So they're a very good role model. I hope that they will influence many other VCs and fund managers to make similar developments. Another good role model is Impact Shares. So Impact Shares is an ETF, an electronically traded fund that was started by the NAACP in the United States, so the National Association, I think, of Colored People. They started this ETF. So if you buy the ETF, first of all, the whole thing is implemented as a 401c3. So in other words, a nonprofit foundation form in the United States. And they all of the fees and all of the returns sort of above and beyond what they need to run the company are recycled back into the company, and the rest is dividended back to charity, in other words, the NAACP, who started it. So really what they've done is they've created this ETF basically as kind of a UNIS type 2 social business, right? As a non-extractive, nonprofit vehicle that is cross-subsidizing charity. So Impact Shares had some success with that ETF. They also created two others, one other for women and one other for climate. So, these are some really good, instructive role models about what one can do by reforming fee structures and using nonprofit entity forms and or steward ownership to implement a financial services company. And I do hope, of course, that this will inspire many others. Many impact VCs, of course, can use this kind of reform. There's a number of great social VC initiatives that are out there. Many of them are centered around things like diversity, equity, and inclusion. I mean, if you consider some of the funds that are out there for women, or things like Backstage Capital by Arlen Hamilton, I mean, these are really awesome, inspiring examples of, leaders who have really put together these funds that are trying to put forward these kinds of underserved communities. You also have funds, for African Americans, and for indigenous and all these different underserved groups. This is fantastic, of course. But even fantastic things can be better. And imagine how much better these funds could be if they were also implemented to be non-extractive. In other words, I mean, what if you took these funds that are helping these underserved communities, but then you also put them under a nonprofit entity form and steward ownership, just to really ensure that there's no financial conflict of interest? Because the problem is, as long as these funds remain extractive, then what can happen is we might accidentally be maximizing shareholder value for our limited partners off the backs of those underserved communities that we're purporting to be helping. That's obviously not the intention. And I would never claim, of course, that this is the intention of those who are starting such funds. But it is kind of a thing that they need to be aware of, that, it's not too late to improve the fund, to reform the fund, and really to build in belts and braces to really ensure that there won't be any financial conflict of interest between those startups that they're helping, and then also the fund managers and also the limited partners. Again, you can realign these incentive structures, and it's going to lead to more purely social outcomes. So it's the same thing also, I think, with other communities that are out there, things like, the Purpose Economy, the Purpose Foundation in Germany that's behind steward ownership. Like they have a couple VC funds and like, why are those funds not steward owned? They should be. Out of anywhere, the Purpose Foundation should be doing it. So, and again, I mean, this is an invitation. I don't mean this as any criticism or blame. These people are pioneers. They are heroes, but even great things can be even better. So, this also for me is really an invitation also towards these parties that think about this. I believe that most of the time people just haven't given any thought at all because it just wasn't an issue that ever really came up. There is no ill will here. But I do think, though, that once they think about it, then they're going to be like, yeah, actually, that makes sense, right? And this is an invitation for anyone who's running an impact VC fund to also put the structures in place to ensure that your fund also is non-extractive, really so we can maximize this social and or environmental value that you're delivering. So another issue, I think, for unusual small funds, is that it's rather difficult to get them started. The reason why is just quite simply fund managers are entrepreneurs, right? And any entrepreneur that's trying to start a business needs customers. In the case of fund managers, of course, the customers are these limited partners. I mean, they need to be able to get these limited partners to put their money with them, basically to buy their product or service, so that they can, and they have to believe in it. Now, smaller LPs are willing to take more chances. So in other words, if you're starting a small and unusual fund, probably it's going to be the family offices and the high net worth individuals and maybe the NGOs that are going to help you to launch. Because oftentimes they're very kind of ideological, impact minded. They want to do something a little different and they don't mind taking a little bit of risk to support something new, right? To sort of help to get it started. But the problem, though, is that at a certain point, these fund managers, they tend to kind of get stuck. Like there's this little chasm at roughly 20, 30 million where they can kind of get to, but then the real larger investors, the larger LPs, like the institutional investors, they don't want to go near it. And the reason why they don't want to go near it is because they really perceive anything that's different as being risky. It's also because, quite simply, it's just too small to be interesting. And there's a lot of overhead for them in moving money in. So, I mean, it could very well be that, they can give you a minimum of 100 million, for as a tranche size, which is great. I mean, we would love to have 100 million, but the catch is that they have to be less than 10% of your total portfolio. And they're doing this due to modern portfolio theory, because of quite simply diversification rules. These very large asset owners need to have diverse portfolios because if something goes wrong, like if the stock market crashes, then they need to have other kinds of classes of assets, things like bonds or real estate or other things to kind of back it up to make sure that they don't lose everything. But it's precisely those same diversification rules that work against the really small fund managers because, of course, how is a brand new fund manager with a kind of different fund, unusual fund, how are they supposed to get a fund of $1 billion that you would need, to be able to get into bed with these large institutional investors? Of course, the incumbents can do this. I mean, BlackRock can snap their fingers and they will have a $1 billion fund tomorrow, but that's just because they have the distribution network already. And of course, more smaller fund managers do not. So really, I guess this leads to some questions because these are systemic issues, and asking the questions, can a pension fund actually diverge from modern portfolio theory to be able to support and create a more diverse environment of smaller, more unusual funds? Would they be penalized by the regulators for doing this? There's a lot of really fundamental cultural aspects, that need to be examined to create this kind of change. Can large asset owners like pension funds, can they create some kind of incubation programs to actually allow these unusual new funds to start and then to be able to grow to the point where they can sort of, cross that chasm and get enough assets that they start being taken seriously by the larger asset owners. I mean, there is no infrastructure for this, but it's worth really investigating whether or not one should be created. Also institutional investors themselves, I mean, this is also kind of a very interesting issue because these institutional investors, like the pension fund managers, they are setting the agenda. When things are going wrong in society, oftentimes the problem starts and ends with these institutional investors. Because again, the asset owners give the money to limited partners, to the asset managers. They create the market, and when they say we want this particular kind of fund, and then you can bet that a fund manager is going to jump up, start that kind of fund, and then try and get that LP as a customer, right? And then, of course, depending on what the fund is, then, of course, that trickles down and influences companies, that the companies influence us, and then, the whole thing comes full circle again. So what this means oftentimes is that these asset owners, these institutional investors, they are actually determining the direction that things are going to go in society. But the majority of people who work as an institutional investor or who are working for a pension fund company, they tend to be very conservative. They tend to be very compliance driven. They tend to be very fear driven and really afraid of doing something different. Because investing in an unusual impact VC fund, if something were to go wrong, this can literally be a career ending move for a fund manager, working at something like a pension fund. So, just the actual culture is not necessarily present within those, the companies and the cultures of these asset owners. And this is really an issue that needs to be addressed. If you think about it, non-extractive finance should be incredibly attractive to the institutional investors. It can be summarized with 2 words: low fees. Because if all of this cash is not getting extracted out of the fund, then what does this mean? It means that more cash is going to be left over for actually, returns, but also, just making companies better, that you're investing in. There's nothing not to love about this. And on top of that, by realigning the incentive structures, what you're doing is you're providing better risk-adjusted returns for these LPs, because you're reducing this conflict of interest between the GPs and the LPs, and also between the companies and society. Everyone's going to behave better. So what's not to love about this? But still, just because there's no critical mass, because it's different, because it's new, that's the reason why it is difficult for these things to get started. And that's a shame, of course, because once you have funds on the market with low fees, this is also going to put financial pressure on the fees throughout the rest of the market, which will drive the fees down, which is better for everyone. So, there's so many reasons why the universal asset owners, why they should, want to get such initiatives started, and why it ultimately will be in the fiduciary duty of everyone. But, to sell this really does need to get them to start thinking a little bit more holistically, a little bit more systemically, and this is a point of attention. There's a really great researcher named Delilah Rothenberg who runs an initiative called the Pre-Distribution Initiative. And she writes actually about this topic very frequently. She's put out a really wonderful paper called ESG 2.0. She addresses a lot of these points and concerns in her paper. So anyone who's interested in learning more about this, I would highly point you in her direction. So, but coming back to us, we the people, what can we do? The first thing that we need to do, I think, is we need to just understand that, again, this is our money. And with the fact being that it's our money, we can raise our voices. And it all starts with understanding what is in my pension. Just do a little bit of research. If you have a pension, do you actually know what the pension fund company is investing in on your behalf? If you don't know, research it, Find out. You might be surprised what your money is being used to support. Once you actually understand what basically you are investing in via your pension fund, then of course you can start asking that pension fund questions. If they're, for example, investing in gas and oil, you can then ask the next logical question, how are you guys voting? Are you actively engaging these gas and oil companies? And if you're not, in that case, are you divesting? What action are you taking on my behalf, right? And we need to look at things just as fundamental as the definition of fiduciary duty. Because if you have people in Gen Z, like most of you in this class, and if you were to have a pension fund, then couldn't you say that not screwing up the world for you guys when you get older, that this isn't part of fiduciary duty? And the great part is you can actually file lawsuits over this stuff. In fact, there was one, I believe, charity in the UK that had actually filed such a lawsuit over the definition of fiduciary duty in order to be allowed to invest in ESG-related funds. And they won the lawsuit. So we can, it can just take a small number of people who want to stand up and take legal action. And these kinds of things can literally move the needle. Because, a redefinition of what fiduciary duty means, this is a small tweak, in law, but it can create, avalanches. These are the things that can really have very wide ripple effects that will affect almost anything. So, we need to organize. And, you can see in the photo that this is a photo of Extinction Rebellion. Extinction Rebellion had organized an action where they were sitting in the lobby of the ABP, which is one of the Netherlands' largest pension funds, and they literally got ABP to divest from gas and oil companies by being there in the lobby. Now, I'm not saying that Extinction Rebellion necessarily did this all by themselves, because of course, it was there was a confluence of conditions, and it's the zeitgeist, and there's a lot of things playing at once here. But at the same time, though, of course, they were that straw that broke the camel's back that actually caused the pension fund to change their behavior. So, there are lobby groups, like also in the UK, you have Make My Money Matter. We don't have such a group like that in the Netherlands, but we should, and it would be really nice if someone could start one. Another thing that we can do is if we are working and we have jobs, of course, we can join things like the Workers' Council, the ondernemingsraad at the company that we happen to be at, or also we can participate in trade unions. Keeping in mind that companies also are the customers of the pension funds. If a company is providing a pension for its staff members, it will oftentimes be selecting which pension fund company it wants to go with. And it could select one instead of the other. You can actually put financial market pressure on these pension fund companies, and they will listen to their customers. So, that's also a way as an individual that you can get your company to speak to the pension fund, and this, is the start of real systems change, and this reminds me of a conversation that I also had one time with a sustainable fund manager, an ESG fund manager from BlackRock. I met her at a development banking conference that I was speaking at. And I asked her, so tell me, how can I change BlackRock's voting behavior? Please, indicate this for me. And why don't we start with 3 scenarios? Like 1, Extinction Rebellion goes to your lobby. 2, someone writes maybe, let's say, a letter to the Wall Street Journal. Or maybe 3, the pension fund manager calls you on the phone. So the fund manager from BlackRock, she said, well, look, Extinction Rebellion in our lobby, this happens almost every day. So, this isn't going to move the needle at all. We're just going to be slightly annoyed as we walk through them, but it's not necessarily going to change anything for us. A letter in the Wall Street Journal, well, it's hard to get a letter in the Wall Street Journal. So if you can manage to get it published, we'll probably read it. We'll probably consider what's being said. If it's going to bring change, I don't know. But if that pension fund manager picks up the phone and asks me for something, that will move the needle. So this is why, if we really want to leverage the direction that things are going in, it really all does start with these pension funds. It's the same reason right now why, again, in the woke finance war in the US, the Republican governors are targeting that pension fund money. This problem starts and ends with the pension fund. So keep in mind that us people can also leverage this. We just need to be motivated to do so. So there are a number of prominent NGOs that have been set up precisely for these purposes of performing this kind of a lobby. Some of the more well-known NGOs that focus on shareholder engagement include As You Sow in the United States. You've got the Interfaith Center for Corporate Responsibility, the ICCR. Let me pause with that. Interfaith. The funny thing is, with a lot of this shareholder engagement, it's actually it's coming from religious groups. You'd be surprised. And one group that's super active in shareholder engagement that you wouldn't think, but they really are? Nuns. Seriously. I mean, these nuns, you don't want to mess with them, and, they're tough as nails, but they do a lot of shareholder engagement, trying to really fight towards social causes. And it's not just, the nuns, it's, not just the Christians either. It's coming from all sides. You've got the investing rabbis, you've got Islamic finance, as measured. Remember, business as a form of spirituality. They're embracing it and using it as a tool for positive change. But of course, you've also got other NGOs. You've got Shareholder Commons in the UK. You have Share Action in the Netherlands. You have Follow This, which is our leading shareholder engagement NGO that is addressing gas and oil. So, this is something that we can do, and it tends to be effective. If you look at the track record of As You Sow, which is one of these engagement NGOs in the United States, you can see they're 30 years old. So they're relatively established. And here is a small excerpt from their Shareholder Impact Review report from 2022. So here's the numbers. The As You Sow team led 196 engagements with 156 companies across 11 program areas. 99 of these engagements were escalated and filed with 79 shareholders, and they withdrew 56 of the resolutions in cases where the companies agreed to take the requested actions. Let's pause here. 56 of the companies, they withdrew the resolution because the company agreed to the change that As You Sow asked for. All right, let's continue. 32 proposals went to a vote with 10 majority votes and a median support of 41.4%. A total of 2.18 million of share value was voted in support of their resolutions. They challenged 15 resolutions at the SEC, won 14 of those challenges, and the proposal was withdrawn in one case. And all of these 196 engagements, they address the following issue areas: climate change in 78 of the cases, diversity, equity, and inclusion in 40, racial justice, ocean plastics, single-use plastics, recyclability, political spending, petrochemicals, pesticides, antibiotics, corporate misalignment with investing, governance, and water usage. Whoa. This is one NGO. And look at the amount of change that they have made. I know Andy Behar, who is the CEO of As You Sow, and I've spoken with him a number of times. He literally has, and this is a bit odd, but he literally has the right, also the fund managers and the 1% after him. Like, he literally has been threatened by parties, among which are the Koch brothers. If you have the Koch brothers after you, then you know that what you're doing is really something that is incredibly effective. So anyhow. And it's not just NGOs that can do this. There's also private individuals that can do this as well. Jan-Feb is, I think, the world leader in shareholder proposals. He has filed over 1,000 shareholder proposals in his lifetime so far. You also have the husband and wife team of James McRitchie and Myra Young, and they have filed roughly 50 shareholder proposals per year. That's one couple. Can you imagine this, right? And on average, these proposals that are submitted by these so-called corporate gadflies, win 47.8% shareholder support on average. I mean, of course, they're being called corporate gadflies because they're just like that fly that's, flying around the tail of the horse, getting kind of annoying the horse. But I mean, they have almost 50% shareholder support for their proposals. Such a small group of people is making such a huge change, and to quote John Chevedden, he says, where else can someone that's never gone to law school beat a $2 billion law firm? So, oftentimes we think that there's nothing we can do. We're depressed and we're despondent and thinking that there's no way that I can make change. Yes, you can. Look at these guys. Look at what they're doing. They are showing that if you have some amount of understanding of the finance system and of corporate governance and you understand how it works, you can make tremendously huge systemic change. It just requires thinking in terms of maximizing proxy votes instead of maximizing for returns, and you don't even need that much money to be able to do this. For example, you need a certain percentage of capital oftentimes in order to file a shareholder resolution. And in the UK, for example, to file a resolution, you need 100 plus shareholders, each holding 100 Great Britain pounds on average per investor. That's not that much. 100 shareholders with 100 pounds worth of shares. I mean, that's monetarily speaking, that we're not talking huge amounts here, relatively speaking, certainly not for a larger group of people. In the US, same thing, $2,000 for shares that you basically hold for 3 years or more. It does mean you need some advanced planning because you do need to have the shares for at least 3 years, but $2,000, I mean, most of us, even here in this class, probably can afford that. So, and that's what we need then to be able to put something on the ballot at the next corporate election. In Europe, it's a little bit harder, but it depends on the country. In France, it's 0.5% of the company, which given, of course, the total valuation of a company, that is a lot. But then you have Norway, and in Norway, it's 0% share capital. In other words, you don't have to own a single share in the company to file a resolution, And this is really because the government wants the voice of the people to get into the boardroom, so that people can put questions on the agenda, and things to vote for on the agenda at an AGM for a company. Of course, the effect of this is you might have longer board meetings, you might have a 4 to 6 hour AGM, but look, if that's the price to pay for having the voice of the people, enter the AGM of the company, bring it on, right? I mean, this is really truly bringing democracy into corporate governance. The Netherlands, on the other hand, isn't doing so well. So the Netherlands is one of the hardest countries in Europe to get a resolution on the ballot. We need 3% of share capital of a company. And of course, that's a huge amount of money. In fact, most asset owners probably don't have 3%. So why is it this way? Well, the reason why is because it's sort of a hangover from 2007 when the activist hedge fund manager, Chris Hohn, and his investment fund, TCI, the Children's Investment Fund, they attacked successfully ABN AMRO. And then in that period of time, you can actually see there's a book about it, The Perfect Prey by Jeroen Smit. It's a very engaging book on exactly what happened during this attack. But basically the politicians in response to this attack against ABN AMRO, this is when they changed the laws to raise those share capital requirements to 3%. But of course, times have changed, right? Because I mean, that 3%, it's no longer per se stopping just these activist hedge fund managers, but now it's also stopping, the Extinction Rebellions of the world from putting in climate resolutions at Dutch companies. So, what it really is doing is it's hindering the voice of the people from being able to reach management. So, we need to make the politicians who created these, these laws in the first place, they can change these laws too. But it requires bringing this issue to their attention. And it requires a certain amount of political lobby, just getting them to understand that, hey, this isn't helping, and this is something potentially that we can change. But of course, there needs to be political will in order to change it. Another issue is proxy advisory services. So a lot of these large asset managers like the pension funds, they don't necessarily always know how to vote because they have huge shareholdings. I mean, they've got tremendously huge portfolios. They might have hundreds of companies, but then when they get these ballots for the AGM, they just sort of look at it and it's like, do you want to reappoint this director? Yes or no? And they're like, we have no idea what this director did, So, I mean, the point is that they hire in these things called proxy advisory services that tell them how to vote. In other words, there's a certain amount of research that needs to be done to vote responsibly and particularly in support of fiduciary duty. So they outsource this job of doing this research to these two major companies, and the market leaders in the space are called ISS, Institutional Shareholder Services, and Glass Lewis. The only thing about this that's a bit weird, though, is that these two companies, ISS and Glass Lewis, they form a duopoly in the proxy advisory services market. And they basically advise 95%, actually more, of the total capital, in the world. In other words, 95% of those asset owners are relying on ISS and Glass Lewis to tell them how to vote. Stop and think about this pure amount of power to shape the world that ISS and Glass Lewis have. On top of that, 20% of shareholder votes are cast within 3 days after a recommendation comes out from one of these proxy advisory firms. Yeah, 3 days. I mean, basically what this indicates is that the asset owner, the pension fund, they probably haven't done research. They probably haven't done due diligence to check that the recommendation coming from these proxy advisory firms actually makes sense. So really what this means is two commercial companies have a duopoly over corporate governance worldwide. Most people don't know this. And this is incredibly strange, and what are the alternatives, right? I mean, if they have 95% of the market share, I mean, what else can we do, right? Here in the Netherlands, there was an attempt early on to create sort of a local proxy advisory service. It was called Shareholder Support, and it ran roughly between 2002 and 2017. Sadly, it's out of business now. But they essentially started back in the early days when proxy advisory was just starting in trying to help the Dutch asset owners to vote about the Dutch companies. And they would really just focused on the Dutch market. The problem was at a certain point that ISS and Glass Lewis basically competed them out of business because ISS, for example, has such huge numbers of customers that they get these economies of scale that they can sell these crib sheets of proxy voting advice for basically next to nothing. It could just be a couple $100 US per voting advice per company, per year. And of course, it's really hard to build a commercial business model to be able to compete with that. But again, then it leaves ISS and Glass Lewis with this dominance position in proxy advisory that's really hard to undo. As You Sow, which I mentioned a couple slides ago, they created an initiative that is called As You Vote, and that is providing more environmentally and socially, basically ESG-friendly voting advice for those who don't think the advice coming from ISS and Glass Lewis are social enough. ISS does provide what they call their SRI, socially responsible investing advice, but As You Sow goes a bit further on the left with this kind of a thing. And the other thing also is there is the issue of pass-through voting. So if you consider, again, things like passive investment, you have the index funds, and again, it's 35% of investment globally. The problem is most of us that invest in these index funds, we have no say in how it's this money, which is ours, is being voted. In other words, our voice is not a part of the process. But of course, engine number one, we spoke about them earlier, they have shaken things up. And of course, also with their introduction of the Transform 500 ETF, this has put some pressure on BlackRock and some of the other makers of ETFs to step up their game. And because with engine number one that the proxy votes are going to be used to vote for ESG-friendly engagement. And that might not be the case necessarily with these other big asset managers. So they've been introducing something called pass-through voting. So there is basically a company that's called Tumelo, and they are specialized in surveying the ultimate beneficiaries, aka you and me, we the people, about our opinions, about how exactly we want our asset managers to be voting on our behalf. And their products, but also just the concept of pass-through proxy voting is starting to gradually get implemented. BlackRock, for example, introduced their voting choice platform. And Broadridge, who is one of the largest electronic platforms for institutional investors, where they also handle their proxy voting, they too have also put in facilities so we can actually query the ultimate beneficiaries. The Index Act was proposed basically by legislators in the United States. I believe it passed. And it basically is requiring pass-through voting for a lot of large investors. So even with the political will, things are changing. The winds of change are blowing. And another major development is the universal proxy card, which also enables us to be able to vote for individual board of director members rather than having to approve or deny the entire slate of board directors as put forth by the management. So we're starting to actually get more choice, and our voice is starting to have mechanisms to be heard. And what's happening is we are bringing democracy into corporate governance. And this is the kind of thing that is just mind-blowing. This is earthquakes, and these are things that can make really huge change moving forward. So, looking then at the role of legislators and regulators in all of this, they can do a number of things to ensure that things continue in this direction. And the main thing that needs to happen is they need to support those people who are doing things right. In other words, they need to stop drowning those who are doing ESG and impact in paperwork and compliance requirements and bureaucracy, because what's happening oftentimes with all of this bureaucracy and paperwork is it is actually discouraging fund managers from starting impact funds or ESG funds, because they know that there's going to be so much extra paperwork and bureaucracy and compliance requirements that they prefer to start a commercial fund, because that way they're going to be rid of all that. So, it's a very perverse incentivization that actually causes people to go more in the commercial direction. But rather what legislators and regulators should be doing is toning down the bureaucracy a little bit, but instead creating fit-for-purpose, non-extractive business entity forms, which we don't currently have, and then reward companies and funds for using these non-extractive models. Yeah. And then finally, if we're going to hinder somebody or hamper somebody, let's engage those who are doing things wrong. Right? And if you're a legislator and a regulator, please focus on the most toxic violators and make things hard for them. Don't spend your time, targeting greenwashing and trying to make things harder for those who are doing things in the name of impact. It's completely backwards. So to wrap things up for today, we need to understand moving forward that we are building the new normal. Post-pandemic, during the pandemic, we were all, wondering what this new normal was going to be when the dust settled. Well, the dust has settled, and a lot of us are disappointed that, hey, this new normal looks an awful lot like the old normal. But of course, some things have changed, and things are continuing to change. And what we need to realize is that we should not feel hopeless about the state of the world, because there is so much that we can do. But of course, it all starts with understanding what the possibilities are, because business and finance can be a tool for activism. It can be a mixed media for art. It can be a form of spirituality, and it can be a vehicle for creative expression. And first, you just need to understand the possibilities, and then the rest is just a matter of personal choice. Good luck moving forward.